everybody, this is Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Dad, Gino Barbaro. Gino, how's it going?
Doing good, Jake. Middle of August, nice holiday season over here. I'm on holiday every day, Jake, down here. It's amazing. Got my mom in town.
What, are you from England? I'm on holiday every day.
Well, I do listen to Peppa Pig with the kids. So I got that little England going on, but it's great down here. I'm having a good week. How about you?
You know, I'm curious because we do listen, to what the folks are saying, and they said that I've been too loud lately. I've sounded like a mic check, break a 19 DJ out there. So I turned the volume down a little bit. We're not tech guys, folks. Bear with us. A couple multifamily drug rep and a pizza guy here. So I've said it a million times. It's a miracle we can get on these calls. So we're working on it. Hopefully it's better. But today is exciting because we have a special edition of the Wheelbarrow Profits Podcast. We're talking financing today. We're talking about the evolution of our financing, and we're talking about a product that we're looking at right now really hard that I think will help a lot of folks out there, especially in the $1 million to $5 million loan range, up to maybe $7 million. So Mr. G-Dad, Papa Funk, Era. How you doing? You ready to get into this?
I am.
Okay. So let's start. What is finance right to us? We talk about our three-legged stool. We talk about buy right, we talk about finance right, we talk about manage right. The finance right is very specific because we want to remove interest rate risk. We want to take it out of the equation. We're looking for a safe, sound, long-term investment. So what does that mean? We like the lowest rate possible. Everyone always talks about rate, but there's more to it than rate. We want to get the term fixed for as long as possible. We want, ideally a 30-30, a 35-35. Now, what does that mean? That means a 35-year term, 35-year amortization. We're paying the thing off for a long time, so we're going to get nice cash flow, but it's fixed for 35 years, so we don't got to worry about interest rate risk. Now, we're going to talk about a different product on this call. We're not talking about the 223F, but we will get into that a little bit. But I love that product because it really fixes for the long term. But again, we're looking for long-term fixed rate financing to take the interest rate risk off the table. So the evolution of our financing. Gino, why don't you tee up our first deal and how it was not financed right, but how it was one of the best things that happened to us because it got us in the game?
Well, I guess it was financed right in one way. We did get owner financing on it, right? So we did.
There was a creative financing piece, yes.
Yeah, so we got 10% of the owner financing done, right? Which was really awesome because we didn't have a lot of money to get into the first deal. And what was amazing about it, we got that owner financing because the sellers were motivated and the deal was on the table for a while. And the bank who we used to finance the property were the ones who had the loan. So they knew that this property was performing. They knew there was a lot of equity in it. That's one of the reasons that happened. So we paid Peter or robbed Peter to pay Paul, whatever that saying is. We went with that bank. Should we have gone to another bank and gone out? Maybe we would have gotten that owner financing piece. So we sort of stuck with that first bank. And I remember the terms. It was a 5-year term, which was pretty standard for commercial loans, especially for community bank. The thing that stuck with me though is we got the 5.5% interest rate, which really hurt. And the other thing was right,
yes,
right, that hurt because rates were around 4.5 at the time. This was 3 or 4 years ago. But what did Jake and Gino know? All we knew is I knew how to flip.
I was thrilled to be getting a new deal, right?
Yeah, and he's walking around selling vaccines. So listen, it's our first deal. I'm looking at the cash flow like, bro, this is going to make us like $3,000 a month. Between we're going to make an extra $1,000 a month on this deal. Cash flow. This is great. I only got to put down 27, and I'm making making that back in like 2.5 years. That's awesome. So sometimes we overlooked it. We learned a lot about negotiating, right? Because we were just thrilled to be in it. Don't be so excited. Don't show your emotions. Higher emotions leads to lower intelligence. Well, Jake and I were really emotional. We're like two little girls. We're giddy about it, right? Remember?
Well, I'm going in with the credibility book, sitting there with the banker, and I'm thrilled that he's just financing the deal. I'm showing him all this stuff, and meanwhile he's crushing us on terms, and he's like, ha 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 ha, right?
And the other thing that most I guess new investors get is that amortization. We got a 20-year am. I really didn't know at the time. I'm like, okay, this is going to be paid off in 20 years. But that really restricted our cash flow. So, we're thrilled. 5.5% interest rate, 5-year term, 20-year AM on our first deal. So you think Jake and Gino would learn, right? So the second deal down the road, 6 months later, it was in July. So we closed about 4.5, 5 months later. Oh, the other thing was on this one, Jake, talk about the guarantors. We just talked about that.
Yeah, it was basically 300% guaranteed. So it was me, Gino, and his brother on this deal, and we each guaranteed 100% of the deal. So they were. I mean, what was the note on that? Like a little over 500,000 or something like that. Yep. So they had like $1.5 million guaranteed on the thing.
We laugh right now because I want you guys to see how it's all about action and about momentum. It's not about knowledge. We didn't have that much knowledge. We had just enough to get into the deal. But if we'd not done anything and just been paralyzed and say, you know what, we're going to pass it up, we wouldn't have 700 units right now. So that first deal was so important to us. We learned a lot in the first deal. Not enough, because the second deal comes along, and what does Jake and Gino do? We got a 3-year term on this one, right? We got a better rate, but we got a 3-year term. Yeah. And
still the 20-year AM.
Yeah, and then the guarantors were 25% each because we brought in a partner. So we learned on that end also, because we really didn't know what guarantors were. You guys have to be very careful about that, because it's really tricky once you get into it. Banks obviously want you to guarantee the lump sum of it. And I think this is I guess a really excellent tip to think of. When you are negotiating with a bank, get the term sheet. Make sure they send you a term sheet, and make sure when you go to negotiate with them again that term sheet is what you guys talked about. Because we've had the deal where we're talking about guarantors. On one of these loans, we want to do pro rata guarantor. All of a sudden, the bank comes back with the term sheet, and they say, no, this is not what we discussed. I'm like, guys, you can't change it in the meanwhile. So be careful when you actually negotiate something and you get it back, that whatever you negotiated about is actually what you guys talked about. Right, Jake?
That's right. I mean, I think the big thing is on the first deal, we really get 10% of the down payment financed by the owners, seller financing. So we were thrilled that we only had to come up with 10% each, right? We were like, oh, forget about the rest of it. But there's so much more to the deal, and the financing is so important. I always say financing is basically as hard negotiating with the banks as it is with the seller for a good price. So it's you have two really difficult levels of negotiation on any deal: one with the seller, one with the bank.
But the whole key to that, Jake, was what do we do right? We bought right.
Yep. That was our saving grace.
Yeah. Well, I mean, if you're buying that deal now in this market, it's probably worth $850 to $900. Mm-hmm. If we'd have made those mistakes, we would have gotten crushed. So Correct. What happens to Jake and Gino? 18 months later, this property is repositioned. It's got great tenants. It's got great cash flow. The property looks really nice. And all of a sudden, what do? We go to refi the property. We pull all our money out. The funny thing is we get much better terms. We got a 25-year AM. We got the rate knocked down by 1 percentage point.
We're 4.25, I think, on the refi. So we're a point and a quarter.
A little over a point. So what happens? We're pulling out all this money, and the payment stays the same. It was like nirvana to us. We're like, I can't believe we created money out of thin air. We've got our money back, and we're still paying the same amount of money. So that's what happened. But the whole key to that was we bought it right, and we created a ton of value on this property because the rents were a lot lower, the expenses were so much higher. We created that value.
And it was pro rata guarantors on that deal, meaning that there was me, Gino, and his brother on that deal, and we were all guaranteeing our share of the equity, which was 33.33% of whatever it was.
And there's two negatives, guys. The debt is still recourse. It's not non-recourse. It's not a Fannie Mae product. It's a non-contiguous. It's a contiguous property, but there's a lot of little cabins and cottages, something that Fannie Mae doesn't like. But you know what? It's still with the community bank, but this property is appropriate for that. It's still cash flowing really well. We've refied it once already. We've pulled all the money out and then some, and it's a nice little asset. It's our first asset. I think it's more emotional than anything else right now, Jake. You think? I mean, it's pretty easy. It's got a little more work than the other properties.
It's the little baby right now.
Yeah. So we learned from that one. So on our third deal, a year after we bought our first deal, it was only 12 months later, we bought a 136 unit complex. Same thing. We went to a community bank. We got in touch with another community bank, and Jake likes always to talk about this. This bank was really hungry. They wanted to grow. They're in the market. They knew multifamily. That was what their niche was. We made a great relationship with them. They liked the mom and pop strategy. We had a strategy. We were looking for mom and pops. We were looking for properties that we could add value to that were under rented. This property fit the bill. I mean, it was right down the street from a 4,500 job manufacturing plant, and they were running at 82% occupied. It was just insane. The value was dripping off this property, but nobody saw it. So Jake and Gino went over there. We got pretty good terms on this property. We got a 25-year AM. The rate I think was around 4.8. Was a little bit higher, but you know what? we take it. And it was awesome. The deal was great. We put 20% down on the second property. Also, guys, we put 20% down on the second deal also. So
no, third deal we put 15% down.
We put on the third deal. We put 15% down. So, but we had to do letters of credit and stuff, so that we had to figure out a way to get that extra 5%, which was great. But the thing about that was we bought that property right. They're all about buying those properties right.
Yeah, and so the interesting thing is, if you guys been on any of the webinars, we talk about refi and roll. So essentially what the strategy is, we get into these things, we buy them right, we get the value up by forcing appreciation, we get the rents up, we reduce expenses, so we get a larger NOI. A few 12 to 18 months out, we refinance them, pull the money out, and roll it into the next deal. So that's sort of been the evolution of the financing, but also understanding the important points. We're now getting 10-year terms, right? We're getting lower interest rates. We're getting pro-rata guarantors. We're going to talk about non-recourse financing in a little bit. The longer amortizations, we're looking for at least 30 to 35 year AMs now. So all of this matters, but the three really important ones: you want to get the lowest rate, you want to get the AM pushed out at least to 25 to 30 years. You want to ultimately, if you can get into the FHA product, get to the 35-year fix, so you're getting a 35-year term too. We're going to talk about that, but the key here is removing that interest rate risk and pushing it out as long as you can.
I think, Jake, there's a couple of things we need to hit on when you do bank lending, though, right? I always say this to you.
I'm not saying don't do it. Like if you have to get into a deal on a 5-year term, it's your first deal. I'm not saying not to do it, but we're just saying once you get in, you understand it more. Where are we going to go, and where's the better place to be for the preferred financing?
But I want all beginners to really stop and think, and we did the same thing. Mm-hmm. You become very what's the word when you're going into something? You become very intimidated by bankers, guys. Money is a commodity. The internet has turned everything into a commodity. Money is cheap right now. Everybody's lending money out there. So what we want you guys to go out there and do is we have a lending comparison sheet that, if you want, hit me up at jakeandgino.com. I want to send that out to you. It has all the things you should be asking about and negotiating about between banks. I want you not to go to one bank like Jake and Gino did. Go to multiple banks. Try to create multiple relationships. Say to the bank, listen, I've got my savings account, my checking accounts. I'm going to bring them to you. What can you do for me? List everything out. On this sheet, for example, we even talk about origination fees. What are banks going to charge you? Jake and Gino were thrilled on the third deal to charge, they were charging us 1% origination fee. Jake goes, what do if he charges 3/4 of a point? The banker didn't even blink. He goes, okay. Jake calls me up and goes, dude, I should have asked for less. So we become very intimidated. Negotiate. It's all about negotiation. It's all about asking A and asking B. Go back, ask the nibble.
I don't think we've paid more than a half a point since then.
Yeah.
So.
And also, even with the loan to value on this bank that we use, they were doing 15%. If we didn't ask for that, maybe they wouldn't have given it to us.
They definitely wouldn't have given. No, that was a hard negotiating point.
Right? It was a really hard one. But you know what? When we did it the first time, then the second deal comes around, they had no qualms about it because they saw we were buying it really well. They saw all the additional value that we could add to it. They liked our business model. That's why we did it. But the fact is, you just have to go out there and ask for every term that's out there. And compare every single bank, A, B, C. Don't just look at the term, the rate, and the AM schedule. There's a lot of other stuff going on. Like I said, you have those closing costs. You have also the availability with these community banks. Well, I guess we could get into it later, but community banks are so much easier to work with. I mean, when you go to Fannie products and Freddie products, they want to know what color underwear you're wearing. They want to know your bio. They want to know so many things about you. There's a lot of paperwork that you need. With community banks, Jake and I found is, okay, what do you guys want? You want some tax returns and some stuff, and it's so much easier to work with these.
Gino, where's the property?
Exactly. Tell them that story. That was great.
I'm not getting into that one. So we talked about the evolution of the financing. We started off community bank, really bad terms, really bad. We got into the deals, we bought them right, so we were okay. But again, it comes down to buying right, managing right, and financing right. We did the buy right, we did the manage right. The finance right came later down. I have a term sheet, for the folks on YouTube right here. Got a term sheet for a product, Freddie Mac SBL, Small Balance Loan Program. Now, I want to go over some of the terms here because as our business is evolving, we're looking at some of this non-recourse debt. And we got some very interesting quotes in the last few weeks, so we want to share this with the community. I want to go over the terms from what I've been told in terms of what the terms are, the standard pricing for these Freddie Mac small balance loans. number one, I think they're looking for about $1 to $6 million. You might be able to, I think it was 1 to 5. I think they just bumped it to 6. You may be able to get a little bit more, but I think it's typically $1 to $6 million. Structure, 10-year fixed, meaning that you're going to get a 10-year fixed rate. Gino, go ahead.
Well, one thing, another part of negotiation, right, Jake? We have a couple of properties that fall below that threshold of $1 million.
Yep.
So really important. We probably would have never done this 3 or 4 years ago. But the guy, we asked him, "Can you do less than $1 million?" Well, since you guys are doing so much more loans over here, maybe we can do the ones that are smaller than $1 million in because we don't want to.
And that's the same thing with the $6 million. If you're 6.5, I think they're going to slide it through, right? It's just there's room around the edges.
Yep. Exactly. It's all about negotiation, right, Jake?
Yep. So I think those are the loan amounts, right? And I think really what they're trying to do is compete with the community banks. I think this product is designed for the smaller apartment space to compete with the community banks. So we talked about the importance of the term. These are 10-year terms. Ideally, I would feel the most comfortable with a HUD loan because they're 35 years fixed. You're taking all the rate risk off the table, but the downfall is you're only getting to draw twice a year. Super high fees to get into it. They're somewhat restrictive. It takes 6 months to finance it. So they're expensive, great rates. It's just they're going to bust your balls really going through it. Bottom
it's
line.
Like everything else in life, though, Jake, right? I mean, a lot of pain, but a lot of reward. I mean, you really have to stick into it. And you really have to have that focus and say, I'm going to get this thing done. That might not be the first deal you get into, right? Maybe I have the evolution like Jake and Gino. You go from community to maybe Fannie Freddie and maybe to this product ultimately.
So we talk a lot about the term and the AM side by side. So the AM on these, the amortization is 30 years. That's great because our community banks, for you guys getting started, we started with 20-year AMs. The community banks now are giving us 25. This product's going to give us 30 years. So if we're going to refi and we're getting a 30-year amortization and maybe we pull some money out, that's going to help keep our loan payment the same. And we're going to be rate locked for 10 years, right? The rate on this one is 4.22%. I think most of our stuff is about 4.25 to 4.5. So we're rate locking for 10 years at 4.22%. I'm thrilled with it. I think that's great.
Yeah, what's Fannie right now? Fannie's at 4.8 right now. So
that's right. Yeah, the standard Fannie pricing that we've been quoted. And this is part of the reason, guys. You may say, well, you guys have been doing this for why the hell have you not gone to Fannie? We have looked at so many different Fannie loans before, and every time they're losing to our community banks by about a half a point, right? Yes, they're going to be non-recourse. Yes, they're going to shoot us out to a 30-year AM. But it's like, to get into it, we're really looking for something really competitive, and we're patient, right? So now this Freddie Mac deal has come along, and we're seeing, wow, rate is actually a little bit better than what we currently have. And in this deal right now that I have in front of me with this term sheet, we're 4.6. So we're going from 4.6 to 4.22. 10 years fixed stays the same, but we're going from a 25-year AM to a 30-year AM. Okay, so this is going to help our monthly payment out. Let's get into a little bit more of the additional provisions here. We're looking at a loan to value of 80%.
Which is great.
I'm great with that, especially for a non-recourse agency debt type product. The debt service coverage ratio, 1.4%. We've got a ton of equity built up into this property. We've had it since 2014. We've been working it really hard. We've seen a dramatic increase in the rents per month. We started at $53,000 a month. The last few months we've hit over 100. So there's a tremendous amount of equity built up through forced appreciation here.
And Jake, let's talk about the rents. It's not just rents. What we ended up doing is RUBS.
Yep.
We got an extra $1,500 a month just in laundry, right? We got all those fees in there. We got late fees, application fees, pet fees. So we've really built up the income a lot, not just from rents, and that's what's important. I mean, there's just, I guess on average, our average recurring revenue as far as fees and stuff is probably about $6 to $7 grand a month just in that property. So don't think of just rents going up. You have so many other types of value that you can build in there.
Right, and so let's say after the thing appraises that we come up with the loan amount of $5 million, right? There's going to be a 1% origination fee on this one. That one I don't know how much more we can beat down. We're going to try, but that's basically going to the broker, right? So that 1% fee is going to the broker. The fees with this program, not that bad. You got an appraisal, you got a risk report. They're saying $2,000. You got legal fees, and then an application fee of $2,000. So for all of the different programs that I've seen from Fannie, Freddie, HUD, these different agencies, not that bad. Not that bad, really. I think the fees are very reasonable. There's an assumption if we were to sell this and someone wanted to assume the debt, it's a 1% assumption. There's not even replacement reserves from what I can tell. I've been speaking to them. There's not an annual replacement, but there may be escrows if there's any immediate repairs that are needed. So that's where they're coming in. So say there's a roof or something that needs to be done, they may say, hey, you guys got to take care of this. Third party reports looking for an appraisal and a physical risk report. This is really positioned to compete with the community banks or compete because they're not busting your chops. They're giving you basically what you want. I'm excited about this. Gino, what are your thoughts?
Well, my thoughts are this. Let's tell them what happened with this property. We bought the property in February of 2014 for $4.075 million. I'm going to give you the infographic, too, of the evolution of the first refinance to the community bank. And it refinanced it out. We pulled out $1.6 million about 18 months to 2 years later. Now, this property right now went through another evolution, a second evolution, and now it's going to appraise for, what is it going to appraise for, Jake? Like over $7 million.
There's probably another $500,000 to take out of this thing.
So we're gonna withdraw another $500,000 on this property. So we're going to be able to pull out over $2 million on one property because we bought it super right. We're in this low interest rate environment that we've been in for the last few years. We're taking advantage of that. So I think the most important thing that you guys can take from this call is you have to take what the market is giving you. We haven't been able to buy a deal over the last 12 months. Every time we approach something, it doesn't work for us. But we're not going to force it because we've seen what happens when you buy right. So take what the market is giving.
It's the gift that keeps on giving, right?
Right. So that's what we're doing. So the other thing we've been doing is we've been shoring up our business. We've been really focusing on our business systems. So if you guys have properties out there and you can't buy something, focus on what your operations are in your property. As far as we've even done email letters. I've written a tenant handbook. I've written a moving guide. We deal with companies like CrowdStreet, Sure Deposit. Start
Lease
focusing
Lock.
on your business. Lease Lock, all these companies that are going to provide value to your product. Maybe you start creating a much better website. Maybe you start focusing on your management systems. You got to take what the market's giving you. So listen, on a $4 million purchase we bought 3.5 to 4 years ago, we've been able to actually now this is going to be pulling out $2 million of equity. Pulling out. The payment is still going to be what we're paying on top of what we were paying.
Yeah, so we're not getting to the point where we're like, okay, our payment's going up $10,000 a month.
No, and actually the loan to value is still the same. And Jake forgot the most important thing, or what are the cherry on top of the ice cream? Interest only, bro. Come on.
Dude, I got it. You got two things I'm waiting on right here.
Okay.
I got 3 years right here. 3 years interest only, baby. 3 years
amazing.
interest only. Yeah, so we're going to cash flow like mofos on this thing even more than we are. We got 3 years IO, and it's non-recourse. So for you guys out there that are very conservative, saying, I don't want this on my balance sheet, you're going from recourse to non-recourse. You're going from basically 25 years to 30, and you're going to tack on 3 years of IO so we can just make it rain. Making it rain out there, right?
So what's great about that is, I mean, guys like us, we're not overextended. But what I'm seeing in the market right now, a lot of guys are buying these properties with this debt, and they're making it work because it's interest only. They're saying to themselves, "Well, I'm going to raise rents. I'm going to add all this value. So 3 years from now, I can maybe refi, or you know what? Once the principal kicks in, and as far as what I'm seeing with rents going, rents can't keep going up at 5%, especially in a lot of markets.
Yeah, because wages are not competing with that, right? Wages are not going to go up that much. So at some point, you hit the wall.
So don't make interest only a caveat where I need to get it to make the deal work. That's just an additional bonus for us. Listen, are we going to keep all that interest only and keep drawing it every month? And let's say we'll be saving like $7,000 a month just on principal on this deal. $7,000 a month, so that's $80,000 a year. We're probably going to put some of that back into our CapEx. We're not going to draw the whole entire thing. We're going to be, wise about the thing. But you're talking about a lot of money in the short term. And listen, I don't want to pay this thing off. I mean, if this thing's going to keep cash flowing like that, my goal is just to continue to cash flow, work the property,
beat the debt down every, a couple, $100,000 every year, right?
Mm-hmm. Definitely, yeah.
So a few other things. Now, I don't want to say that this is the Nirvana product, right? Because everything's got its limitations. The one thing to be super conservative that I don't like about this is that it's got 10-year interest rate risk, which is not, 10 years is a good amount of time, right? We're gonna be, pay the debt down over a 7-year period because we got IO for 3 years. But there is the HUD product out there, right? That's going to lock you for 35 years. It's going to be 6 months to get into it. There's going to be a lot of fees, but you're done, right? You get into that product, 35 years. There's zero interest rate risk. If you bought right, you lock it for 35 years. The only thing you got to focus on at that point is the management. So we're looking at HUD deals too, right? They're a little more, bureaucratic. There's kind of a pain in the ass to get into. So we like that product as well. That's the HUD, I guess it's FHA 223F. So you guys can look into that. But these Freddie Mac, here's the other thing too that we're looking at. If we put some of our deals on the FHA program, getting out the 35-year financing, some of them on 10 years, our blended interest rate risk may end up being 18 years or something like that. So the key is we're buy and hold guys. We're not looking to buy and flip anything. We're just looking for long-term cash flow, spreading the risk out a little bit, and then maybe getting into some of these nice IOs, building up the cash flow, building up the war chest, so we can go deploy that when the market does turn and pick up some more assets. G-Dad, how you like that? You like that?
I think that's good. I mean, I love it. I mean, it's taken us a while to get here, right? I mean, everyone talks about the nirvana with non-recourse debt. And obviously, if you start from the very beginning and you start a syndication, you've got to raise private money, you've got investors. Obviously, this strategy may not work for you because, your investors want that non-recourse debt. But for guys out there getting their first deal, listen, it's a great way to start. And if you can't get into a deal, find partners. Start partnering with other guys. Get your balance sheet to shore up and make the deal work. It's all about getting that great deal and then going out there and making relationships, because real estate ultimately is a relationship-based business. Jake made a couple of great relationships with the Freddie broker. He's a really great guy. Gets back to us, and you want guys who are hungry. That's the bottom line right now. And this is one of the problems I think that's going on in the multifamily space right now. A lot of these brokers are so busy. They've got so many deals that it's just like, they don't even get back to you, right? Because there's so many deals. But you want to find guys who are hungry, who want to get the job done, and who will negotiate with you, who are fair with you. I think we've laid out all the terms really well, Jake. I think people need to know right now from this call what to look for in financing. Yeah.
So I'll do a quick recap. So we got with the Freddie product, we got a 10-year term, we got a 30-year RAM. On this one, we were quoted 4.22%. We got 3 years IO. Anything between basically $1 million and $6 million bucks. 80% loan to value. Debt service 1.4. Fees were pretty reasonable. 1% origination. See what we can do with that. We'll talk about that with the broker. Anything else, Gino?
I think the last thing, Jake, is, do you remember that myth that people say, oh, it's hard to get a loan on multifamily? I think the funny thing is we found that it's easier to get a bigger loan than it is to get a smaller loan, right? Because these guys make more money on bigger loans, and they want to work.
They want to do the bigger loans, absolutely, yeah.
And it's really weird. And when I first got into it, I'm getting a $300,000 mortgage. It's hard to find the mortgage broker who wants to go out and do a smaller loan. So that's to your advantage. If you have these bigger loans, you got guys who are going to make, hey, listen, $50,000 on a deal like this. That's great for the guy. He's going to work for that. So he does a couple of those deals a year. He's doing pretty well, right?
Well, this is the hardest thing to understand about multifamily is that the bigger loans, if the deal works, is going to be easier. The bigger deals are better because the companies that you're dealing with understand expenses, right? And they understand that there's more sophisticated guys in the bigger deals that you do. And the bigger deals are easier to manage. People have a hard time believing this, but a 200-unit deal is going to be so much easier to manage than a 15-unit deal. So do what you got to do in the beginning to scale up, build up your assets. But as you grow, your economies of scale, the bigger assets, the bigger loans. I personally agree with that it gets a lot easier.
Well, the thing is what Jake's talking about with the bigger deals, and this is what it was hard for me to understand also. You can actually start hiring people. You can actually have a couple leasing agents in the office. You can have a couple maintenance guys. It's not just you running around. Now, maybe your expenses are not $1,500 a unit with a 10-unit property. You're going to make less cash flow per unit, let's say. But with the bigger property, you're just much more insulated. You're spreading out your risk much more, and you have people that you can actually help you grow. And that's what ultimately it's all about. And then you start throwing cost seg on there. You start throwing IO on there. You start talking about, like Jake said, Jake likes to go make it rain, man.
No, that was air guitar. That was air guitar for cost seg because I love me some cost seg.
You start talking about hurricane season when you start getting all that stuff going on these deals.
Listen, Gino's been in Florida. He's talking hurricane season now.
Bro, you make it rain. We're gonna make it thunder. You know what I'm saying?
You're killing me. Awesome. This has been great, guys. I hope this was helpful. And if you get a chance, you like it, go ahead and leave us a review on the podcast. Gino, anything else?
We're having a live event in November.
Yes,
11th
the live
to 12th.
event.
So
These guys are going to be there too. We're gonna have Freddie brokers there. We're gonna have community banks. Let them duke it out for your business, right?
And that's what I wanted to say. There's going to be a lot of these professionals out there. We're going to have our insurance guy out there. We're going to have our cost side guy out there. We're going to have somebody from our software out there. I mean, there's going to be a lot of guys at that event, plus the Jake and Gino community. So if you need any information, go on our website. It's Multifamily Mastery Live. Hit me up at jakeandgino.com. I'd love to talk to you guys. And also for that bank lending comparison sheet, hit me up and I'd love to send one over to you.
G Dad in the house. I'll talk to you later.
Thanks, Jake.
See ya.
Bye.